It's an election year. How will the midterms affect the market? Hello, everyone. I'm Patrick Fross with Fross & Fross Wealth Management. Experts. Here's our fourth subject for today, the U.S. political impacts. So did we forget it's a midterm year? You know, it feels like this has really fallen to the back burner. Much less do we remember the government shutdown late last year and the continued funding bill that started to impact us this year. Do you remember long TSA lines, shortages of air traffic controllers, and so on? But we know that, as time goes on, these things start to get fixed. But let's talk a little bit about what we think the political impact would be. And of course, we know a big driver of market returns in some ways can be affected by Congress. We know the balance of power is very tight in the U.S. Senate and in the House. Right now in the House, there's 218 Republicans, 1 independent, 215 Democrats, 1 vacant seat. And we see something similar in the balance of power in the Senate with 53 Republicans and 45 Democrats. So things are very close. Now, historically, not to be the bearer of the bad news, but usually the party of the sitting president will lose seats in the midterms, albeit with 3 exceptions going back to 1934. The question is, will a shift in power have a major impact on the market? Well, if we look at over on the right side, Republican president, historically going back to 1949, a Republican president with a Democrat Congress had average returns of 7.5%, with a Republican Congress 11.4%. If it was a split Congress between Senate and House, split, one side controlling the House, one side controlling the Senate, the market seems to like that. That 17.6% are the average returns under that scenario. Why is that? Well, it's because the market loves gridlock. The market loves a split Congress. And that's because nothing's getting done. The market hates uncertainty. And when Congress is in there passing bills and spending bills and tax bills and changing laws, that has a negative impact on the market because nobody knows what's going to happen with tax law and spending and where money is being appropriated. So it creates this uncertainty and the market doesn't like it. But when there's gridlock, the market loves it when nothing gets done in Washington. Now, as far as the average returns before, during, and after a midterm election, if we look at the orange bars, the quarter between the midterm, that's the quarter we're in right now. The average return is 1.1%. The quarter of the midterm, which is the fourth quarter of this year, the average return is 7.6%, and the quarter after the midterm, even better at 8.2%. So historically, we have good returns coming in the market. But there's definitely going to be volatility. In fact, volatility in a midterm year is the highest volatility that we see during any